So something interesting has been happening. We're changing the way we talk about sovereign debt. By sovereign debt, that's just a country borrowing money. We used to talk about it like it's dessert. So before dessert, right? You can have it, but go easy. Baklava, bad. Now we're starting to talk about it like it's protein. Too much might still be bad, but too little might still be bad too. You might get a little anemic. So now, protein. That said, it's very difficult to figure out what the right amount of debt is. It's hard to optimize sovereign debt because the stakes are so high. Here's one way of looking at it that we borrowed from Olivier Blanchard. He used to be the chief economist at the IMF. What we're looking at right here are two measures, G and R. G is your growth rate. This is the nominal growth rate of the U.S. economy. That is, we're not adjusting for inflation, we're just seeing how much bigger it's getting quarter after quarter. R is return. So this is the return on U.S. debt. This is what the U.S. pays to borrow. This happens to be for a one-year treasury. You could do a 10-year treasury. You could do any number of things. There are different ways to adjust it, but the story remains basically the same. So here's the question that we're trying to answer. Is G greater than R? So if G is greater than R, that is, your economy is growing faster than the cost of your debt, you may be able to borrow more, right? So if G is greater than R, that may be okay. Because what happens is, even though you're borrowing more, your ratio of debt to GDP will remain stable over time. However, if G is lower than R, then your debt to GDP ratio will start to rise. That could become a problem. Lower than R. Again, we don't know what's going to happen there. Historically, G has been greater than R. You can see it's true over here in the 60s and the early 70s. That changed, and the reason that's important is that there are a lot of people in policy and in politics still who have formative experience from these years right now that were a little scary. There's a famous James Carville quote. He was an advisor to President Clinton, where he said, "I used to want to come back as a baseball player. Now I want to come back as the bond market because everybody's scared of the bond market." Right here, G and R were trading places pretty regularly, right? So here's what we have. Important. Carville scared. We used to be scared of these mythical creatures called the bond vigilantes who would punish you by raising your cost of debt if you borrowed too much, right? Again, this was when we were talking about this. Terrifying. However, what's happened over the last 15 years or so, since 2000 and definitely since the recession, is that G has been consistently greater than R, and you can see that gap right now. So does that mean borrow away? No. And Olivier Blanchard would also definitely say no, it doesn't necessarily mean borrow away, but it does mean that debt isn't definitionally bad. It's not like dessert where it's bad for you no matter what. It might be good, it might be bad, but we have to look at it rationally and figure out what are the costs of borrowing too much, but what are the costs of borrowing too little? So where are we now? It used to be the baklava was bad. Here's where we are now. Kobe beef, I don't know, might be good.